All right, welcome everybody. On this week's episode, I am very excited to have a special guest, CJ Estel, a real estate investor from the Lancaster area outside Columbus, and he has an amazing story to share. He has had crazy growth with his portfolio, and he uses a lot of really creative and exciting ways to do it. So you're going to enjoy the story. You're going to get a lot of good tips from it. So without further ado, welcome, CJ.
Thank you.
Hey, glad to have you on. So I have bumped into you, I've seen you online. We bumped into each other at OREA, right? And then, so there's been different interactions here in probably the last 3/4 of a year or so. So I've heard pieces of your story in big chunks, but for everybody else, really, what is your story? How'd you get involved in real estate? What was that beginning? Before we get into the big growth, what was the beginning?
Yeah, so I actually ran a small IT consulting business years ago, and started it before I really had studied much about business or knew much about business process, and did all right for myself, but I was set up to where I had to go out and basically do what I call slay a dragon. If I didn't go out and make sales, I didn't have any recurring revenue. So I had to go out and make those sales to be able to have the funds coming in to do what I needed. And I found myself in a pattern of sell, 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 work, 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 sell, 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 work, work, work. And when the '08 crash hit, some of my bigger customers ended up going out of business. And as I'd lost that income, without the recurring revenue, without some of those funds coming in, I really started to reflect on business and some of the processes and what it took to run a successful business, and realized I had not set my business up from day one to be successful. So I actually left the IT consulting business of my own business and joined the corporate world for a while to kind of get back on my feet. I was on the verge of bankruptcy. This was about 10 years ago. And the corporate world really helped me stabilize things, get back to where I needed to be financially. But I've always had this entrepreneurial spirit. And as I started to learn a little bit more about real estate, the recurring revenue was really, really attractive. I've always told myself I'd never do another business that didn't have recurring revenue. And real estate was just a really great fit. That's kind of what drove me to get into it. I guess the other thing that really drove me, the corporate world, like I said, it really helped me get back on my feet. It set me back up to be able to comfortably retire around the age of 65. And that's not what I want in my life. I don't want to be the old guy that, yay, I finally got done working. Now I can enjoy my golden years in a state that I'm not able to enjoy them. So really wanted to accelerate that financial independence, and real estate kind of checked off that as an investment strategy as well. So a lot of forces kind of driving me to it. I've got a little bit of a background in construction as well. Done a lot of DIY type stuff. My dad was a handyman on the side as I was growing up, so got to see and absorb some things that way, and kind of helped me as I look at different strategies of buying up distressed properties or things like that, being able to more accurately estimate repairs and things like that. So it was a good way to figure out the numbers and be able to jump into real estate.
Sure. Were you reading books, or how were you doing your research or toying with the ideas?
So I did a little bit of reading, not so much on the book side of things. I'm an avid blog type reader, so a lot of my education comes in shorter bursts. And then I try to surround myself with good people. Honestly, my first investment property I bought before I was married. It was supposed to be a flip, and I apologize for the background noise here on the street level. But it was supposed to be a flip. I bought the worst house in the best neighborhood. I'd read that's what you should be doing. And bought a 5-bedroom house for about $115,000. The neighborhood was mostly in the $180,000 to $200,000 range. all cosmetic stuff, and thought I'd be able to put $15,000-$20,000 into the house and do really well on it. And while I was living there doing that house hack, met my wife and kids, and the home became less of an investment and more of a home.
Yeah.
So we ended up doing all right on it. We lived there for a few years, but the wife wanted an in-ground pool and things of that nature. So, our rehab kind of went out the window, and we had a few things that I probably wouldn't have put into a flip otherwise.
Yeah, that happens.
It does, and I don't regret any of it. But so that was kind of my first attempt, and was a little deflated. Didn't do terribly great on it. Basically lived for free for 6 years by the time I ended up selling it, and we weren't 100% finished with everything either. But I didn't really make much on it. Just kind of lived for free for about 6 years. So still had some equity. Was able to roll that into a new property when we moved. And from there, we lived at the new house for about a year and kind of talked to the wife. We had a personal savings goal in our retirement accounts and stuff. And I said, honey, we're on track to retire when most people do, but it's not going to get us where we need to be. Let's try to jump back into real estate investing. And honestly, my first house I bought, and I don't necessarily recommend people do the exact approach I did, but I did not learn nearly as much as I should have. My first house, it ended up being an all right investment, but not because of my own due diligence. It was a $100,000 house. I put in an offer. They gave back a thing saying, hey, there's renters in there paying $750 a month. I was like, cool, that's more than I was going to charge. My mortgage is only going to be this much, right? And so clearly had absolutely no idea how to crunch numbers or anything else. Ended up taking on those tenants, and the people were selling it because those tenants weren't paying their bills. So I ended up having to go through an eviction. They trashed the house on the way out, so I had to go through a pretty extensive repair. So I got my feet wet real early in the process. Like I said, it's a good investment now. I got everything fixed up. It now rents for $1,250 a month. So it is a good area, good house. Probably wouldn't have been knowing what I know now, I probably wouldn't have bought it with the amount of work that it took to get it to a good spot. But the amount of learning that I gained from that was absolutely amazing. And I quickly, after I purchased that, bought a second property. And it was after the second property, as I was getting into my third property, where I started attending user groups and found people to kind of mentor me and teach me how to crunch numbers, teach me the things I didn't know, just immerse myself around people that were doing it as much as possible, started attending as many different things as I could. And that's where most of the educations really come from, is trying to surround myself around people that do it.
That's sure. So when you were, going to these groups in the beginning and you had few houses, did you find a bunch of resistance from other investors not wanting to share their information, or was everybody fairly open? What was the room like?
So I found that at least down here in Lancaster, I can't speak too much to other areas. The areas I've been to outside of Lancaster have mostly been the same. Most of the investors I talk to are really open about what their strategies have been, really encouraging. There are plenty of deals to go around. I mean, they're not going to share their private lender list per se, but they're all about helping educate you and teach you. I haven't had anybody really push back from an investor side of things, but there's a lot of naysayers out there that, why are you doing this? You've got a good job. What's the point of this? Why are you putting in all this extra time? You should be spending it with your family. And I'm kind of looking at it as, this is an investment for me to spend time with my family. And if I can do this over the next couple of years, that's going to get me set up to a point where I've got a lot more ability to spend time with my girls as they grow up. So still get some pushback from family, friends, as they see me putting a lot of time into a day job and a side gig. But the investors are not the people that push back.
Sure. I mean, I think it's a good point and a good encouragement for anybody wanting to get started, looking for information, wanting that encouragement to go to a local meetup, RIA, in your area. The Profit with Real Estate group is an awesome group. And I mean, in my experience, by far, people are much more open and willing to share than they are critical or closed-minded with their ideas. So I've had the same experience. With people telling you you're working too hard or you're sacrificing too much, are there points along the way that you started to believe maybe they were right, or have you been able to always just push them aside? Because I think that's natural when you're doing something different than the bulk of people. You get that resistance or pushback. What's been your experience?
So for me, it all comes down to goal setting and working towards your goals. As long as you know what you're working towards and you step back and evaluate your process and your progress towards those goals, that's the most important thing. You're always going to have people that think you should be doing something different. And frankly, I solicit as much advice as I can from as many different sources. I don't want an echo chamber. I want to hear people tell me why I should be doing it differently so that I can really sit there and think on that type of thing. And for me, having that goal, knowing, okay, I want to leave my day job by this particular date. I want to have this much in passive income. Once I get past that, my goal is to, start to travel this many times per year. I lay those things out, and it reminds me what I'm working for. So, it is a sacrifice when my wife calls and says, Jalen's on the phone. She wants to tell you hi and whatnot. It's hard to not be at the house, but as long as you're achieving progress towards those goals and you know what they are, I think that really helps you get through it. And if you're not getting to where you need to be, then you need to reevaluate your goals and your process and figure out what needs to change. But at least tracking it is where you have to start.
That's awesome. I think, a lot of times people who are working a day job and they're equating time with money, they don't realize that when you're putting in that extra time in real estate, it's no longer the money that you're making is no longer related to your time. Every house that you finish, when you're still working on the next house, it's the first house is providing you money. When you're working on the 20th house, those first 19 are providing you money. And they don't really understand the exponential nature of it. So they don't see that not that many years down the road, you don't have to work near as much as even they are, or a full-time job.
Yeah. And I'm 30, going to be 38 here soon. And most of the real estate that I have at this point is in commercial notes, and they're 20-year notes. And I look at the amount of principal that I've got going towards things, and my tenants are paying more principal than I could ever put into my 401k at my day job. So it's really interesting to not only look at the cash flow, but to look at the appreciation in the properties, to look at the principal pay down that you get, and the tax advantages that you get with everything too. So, while I'm in my day job, it's really fun to look at those numbers, but ultimately when I want to leave the day job, the cash flow is the thing that matters the most. So it's a different perspective when you're looking at it, as an investment. And there's nothing wrong with that. If you want to keep a day job and say, hey, I just want to build this up on the side, you can take deals that somebody who's doing this full time wouldn't be able to take. And there's nothing wrong with that.
Right.
Just it may not have the cash flow. It's still going to be a great investment over time.
Yeah. So. And people need to realize that if they have to put in a bunch of extra hours early on, they won't always have to. That eventually they'll get away from that. So.
Yeah, and that is one of the things. I do work a lot in my real estate, but one of the things that I learned from my IT consulting business, as I really started to study, business processes, you have to be able to pay yourself to do things. So I kind of looked when I first started on my third house was my first rehab property. I said, you know what, I could go and I could rehab this property after I'm off from my day job, but I'm going to pay other people to do this. I'm going to hire some people. And I'm gonna handle things that way, and it really allowed me to free up some of my time to work on the business. I could start to evaluate numbers. I could work on my education. And when I got done with that house, I actually ended up way over budget on the house. But I was able to step back, and had I done that work myself, it would have probably taken me about 6 months longer to get the rehab done, because I wouldn't have had the amount of time to put into it. And I could have looked at that and said, you know what, I made this much money, I was this profitable. By paying other people, it really forced me to be able to take that time that was paid into consideration and say, you know what, I actually broke even on this property. And then you also look at that opportunity cost of, if it had taken me 5-6 months longer to finish it out, well, the place is rented for $850 a month. You know, that's thousands of dollars on top of that I lost if I was doing that work myself. So, you know, that stepping back and working on numbers, really evaluating, you know, the deals from a step back is something I highly recommend to people. And pay yourself. If you can't pay yourself, you can't pay somebody else to do it. And you've got a lifestyle business, not a wealth building asset. So
good point. Sure. All right. So let's go into the details. When you started, what year was this, or around what time frame?
So this was April 1st, so not too long ago. That was my 2-year mark. So I've grown pretty rapidly throughout there in 2 years' time.
That's awesome. Okay, so just over 2 years, you have over 100 units, right, of varying types, which we'll get into. But how did you, if we're talking in a 2-year time frame, and when you talk about starting 2 years ago, it sounds like 2 years and 100 doors is not a typical growth sequence, right? But when you tell your story and you say, I bought this one house, and then we had hassles with the residents, and then I bought another house, and then eventually I bought a third house. That sounds like a typical sequence. So how did it go from, the normal buy a house and a month or 2 months later buy another house to this crazy growth?
Yeah, so the first 2 houses that I bought, I have grown highly leveraged for starters, and I want to kind of call out to anybody who might be listening to this. Make sure to understand your own risk tolerance. A lot of people probably don't want to do what I did, and that's perfectly fine. But my first house, I used money off of my HELOC for the money down of my primary residence, and that went well.
Just for anybody not familiar with it.
Yeah, so typically when you buy a house, you're going to have a little bit of money that you put down onto the property, and then you're going to have a little bit of principal pay down. So on my own personal residence, when I put money down on the property, and then I had done a handful of repairs to my own property, which caused the value to go up. So I was able to get basically a bank's line of credit with my house securing that, the amount above my note. So if I owed $200,000 on a $300,000 house, some banks will let you do on your primary residence 80, 85, 90, 95. Some banks will even let you do 100% of that equity. So in that particular instance, if you can get a bank that'll give you up to 100% of your equity, you can get a $100,000 line of credit in the form of a home equity line of credit.
Sure.
So I was able to use money, basically equity in my house, to put that down towards the first property. And after I closed on it, while I was actually in the process of going through the loan, I've got pretty decent IT day job, and I'd found a duplex before I was even closed on the other house. And I asked the lender, like, so what would it look like if I wanted to get this other house? He's like, well, let's get this loan closed first, but your income looks good, so if you've got the money down, we can get that closed without any issue. So bought the first house, and then immediately got ready, and the following month bought the duplex. And I used for the money down on that. I had a Roth IRA that I'd had for a while that I'd contributed to pretty regularly. And with Roth funds, I think it's after 5 years you're allowed to touch the money. Talk to a financial planner, accountant. But with Roth IRAs, you've already paid the taxes on the money, so you can take out your own contributions without any penalties. So I took out money from a Roth IRA that I had to put money down towards the second house. So the first house, even though it was secured against my primary residence, I still borrowed 100% of the money, right? 80% from the bank, 20% from my house, basically.
Yeah.
the second house, I went ahead and borrowed about 20 grand or so or I took as a withdrawal rather from my Roth IRA, put that down for that loan. And then I had read a lot about this BRRRR strategy where you buy distressed properties, rehab them, rent them out, refinance to get your money back, and then you repeat the process. And the goal with that strategy is, ideally you want to be around 70% of the valuation of the property by the time you're all said and done. So you buy it, you fix it up, and you're at $70,000 on a $100,000 appraisal. And that allows you to give the bank the 20 or 25% down that they want. You make a little bit of money, and you get all of your money back. So I read that strategy, found a distressed property, started working on it. And like I said, I went way over budget. I even did all the due diligence on that one. I had the home inspection, whole nine. There was a spot. We knew we had to gut the bathroom, and that particular area was bricked off, so you couldn't get under the crawl space to it. And when we got the bathroom all tore open, the entire interior foundation wall was crumbling on the inside, wasn't visible from the outside. We got to jack the back half of the house up and do all kinds of work to that. So I funded that largely off of my HELOC. I had found a lender that was willing to work with me. My first lender, who closed those other two loans quickly, easily. He's like, okay, well, we're at your debt to income limit, so I can't help you out anymore. So had to kind of shop around and find a lender that was willing to work with me. Found somebody to give me the money for the purchase minus the money down, and then did that rehab and was then looking to refinance that out. And I went so far over budget, I didn't have any equity in it to really be able to refinance. So I was just kind of stuck with my HELOC maxed out at that point, no equity in this property. And I was like, okay, well, I'm done for a while. That was a fun run. I'm going to have to wait this out. And I thought I was done with growth for a while. And
it was around the third property.
That was at the third property. So I had a single family, a duplex, and then another single family. And it was a couple of months later, one of the people who I had met through networking and whatnot at various meetups, he'd kind of taken me under his wing. He's the primary person who really showed me how to crunch numbers on properties and how to plan for the capital expenditures and vacancy costs and everything that really goes into it that I hadn't known to consider by just kind of jumping in the way that I had. So I'd gotten a much better education base, and he had actually gotten a handful of properties under contract together, and he wasn't able to take them all down himself. So I'd never even heard of the concept of wholesaling or anything else. And this person who's kind of my mentor mentions like, hey, I can give you a good deal on a property. And I'm sitting there like, is this good? Like, do you buy? Like, I mean, the price sounds good. What am I not understanding? Are you trying to take me for something? He really is just a great investor that, had a great deal, and he was passing it along. And so I looked at the price, I looked at the income. It was far better than any of my other three properties. And I just had to find a way to make it work. And I went to bank to bank to bank to bank, and they're like, well, you've got a lot of credit used up here. You've got a lot of houses. We have no idea if you're going to be good at actually managing tenants. You've been doing this for all of 5 months. No. And it was just constant no. And I kept shopping, and the numbers on the property were amazing. I was getting it for, I think, $82,000, $82,500, something like that. And it pulls in $1,500 a month in rent. So,
wow. So it's almost 2%.
Right? Yeah. So I ended up hearing about Visio lending. They're with what I know now, kind of borderline hard money lender. I paid, I think, 5 points to get like a 7.1% interest rate with them. And it has a 5, 4, 3, 2, 1 prepayment penalty. But I was able to refinance my HELOC into a new HELOC to give me more available credit. I used that money down for a loan with them, got everything approved, and was able to add on the duplex. It's a side-by-side, and then the garage rent separately to the neighbor across the street for storage.
Sure.
So got that closed and kind of was again of that mindset, like, okay, nobody really wants to lend to me. I'm done. I don't really have anywhere else to go. And as I continued to attend meetups and things of that nature, I started hearing about private money and some of the other things. Like, wait, there's a way that you can buy houses without banks. It was just completely astounding. Let's see, my next house.
That on the nightly news, right, or in school,
Yeah,
or it's only
it's amazing. Like,
yeah.
So we'll talk a little bit more about that as I get into the private lending. I'm going to start to get into some of the gray areas that I probably don't recommend most people do. One of the things I had learned when I was near bankrupt with my IT consulting firm before I went back to the corporate world to bail me out is that banks don't want to give you money when you need it. They want to give it to you when you don't. So while I had worked to get myself back on my feet, with that knowledge, every time I got a raise or anything else, I got all my credit cards paid down, I would call the banks and I would see if I could get my limits raised. And across the board, I had over $200,000 worth of credit available on these cards. I would constantly get all of these 0% checks. And the 0% check's not really 0%, right? You're going to pay a 2.5 or a 3%, upfront fee, and then a 0% for 9, 12, 18 months, whatever the term is, right, for that particular card. But I was in a networking group that's a business networking group, and one of the people mentioned that they had a house that they were trying to sell. They were power of attorney for the person. She'd just gotten admitted into a nursing home or long-term care facility of some sort. Was on Medicaid, and they had to get rid of her assets. And this house was in terrible shape. The lady was blind, and there had been like a house fire, and things had just gotten not repaired properly. And it struck me as somebody had taken advantage of the person who was living there, the way that some of the things were done in the house. But I was able to pick the house up for $25,000. I wrote a 0% check off of one of my credit cards to buy a house. And got that house, and it actually worked out really well because the guys that I'd hired for that third place that I fixed up, between the eviction and everything else, I was able to keep them busy. And then it's like, okay, cool. Now I've got this, place that needs all kinds of work, so I can just keep them working on it, and I'll be able to pull them off whenever I have a tenant need that comes up as I get more and more tenants. So I had a little bit of a lull in January of that year, where I didn't have much work, and I actually almost lost the guys. They're great. The guys I've got working on there are fabulous. But got through January and picked that up, I think, in late February, early March, something like that of that year. So got them started working on that, and then had somebody else call me, actually the realtor that I've used, I've been friends with him for a long time. One of his friends called him and said, hey, my boyfriend's got this property. He wants to sell it, but he hates going through realtors. Do you know anybody who's looking to buy anything over in this part of town? And I got to talking with the guy, he got referred over to me. He's like, yeah, I just want what I got left on the loan. I've been living here for about 17 years. And, my mom passed away, and I'm, inheriting her house, and my fiance has her house, and I've got this, and I just want to be done with it. I want to walk away if I can. And, the house only needed about $12,000 worth of work. Wasn't in terrible shape. Ended up picking it up for $47,000. And the, appraisal came back at 84. So, really good deal. Ended up putting that money in. If I had to guess, it would appraise probably closer to 100 now. So I had these 3 properties, and I found a lender that was willing to do a blanket mortgage across multiple properties. So I had that property that I wanted to buy for $47,000. I had the property I had just bought for $25,000 on a 0% credit card. And then I had my Burr property that was an abysmal failure. That was my third property, but there was a ton of equity because I paid for it all out of my HELOC. So I found this lender that was willing to do an as-complete appraisal on the $25,000 home that I had purchased. And the as-complete came back at $92,000. They went off of the other appraisal that came back for the property I was picking up at for $47,000, and then I had all the other equity in that third property. So I was able to roll all that together into a single mortgage and walk away with over $100,000 cash. And basically I sucked all the equity out of those properties, so they're about cash flow neutral at this point. But I walked away with $100,000 that allowed me to pay a bunch of stuff off and kind of start the process over again with empty lines of credit and be able to continue to grow. So,
well, it seems like that's a great way. I mean, using a HELOC, with that technique for the BRRRR, when you refinance, you're going to repay that off similar to your credit card check, and they're all different short-term financing essentially that you refund with that portfolio loan. So that's pretty sharp. So I think I know the answer to this, but did you have it all planned out from the beginning when you bought that third house? Did you know how it would all work out with those three?
My initial goal was, I think I want to be at around 50 doors by the time that I hit my 10-year mark in investing. So after year one, I was like, I think I need to shorten that. Let's do 50 doors in 5 years. And then the second year kind of started rolling around, and I realized that a door count doesn't mean anything. It really is a completely arbitrary number. What you really need to care about is what do you have in equity and what do you have in cash flow. So my goals have kind of changed away from that, because you can buy any deal you want and you can get door counts. You can be losing money, right? So you need to have a set amount that you're making per door, or you need to be looking at the actual gears that matter to get towards your goals. So
yeah, that's true.
The next property that I bought was a 6-unit. It actually came a mastermind that I got invited to be a part of. One of the investors is like, I looked at this house. It was just a little too rough for what I wanted. I was like, that's right up my alley, So, and I'd just done this $100,000 cash out, paid off a lot of my own stuff. But I had to make sure to keep money back for the repairs and stuff. So I basically got the repairs for that $25,000 house funded up front. And this cash out. So I had to make sure to set money back, and the house, I was able to get it, the 6-unit, I was able to get it under contract for $85,000. Needed a decent amount of work. I've probably put $35,000-$40,000 into it. But got it up, got it rented. The utilities aren't fully separated. So, ended up doing utilities included. It's actually worked out a lot better than I thought it would. When you look at the way that heat and everything works, you just get efficiencies, in the building there. So, and I try to limit things. I've got Nest thermostats installed, so I can make sure to limit the ranges and things like that. The tenants can change the temperature too. And there's a flume water device that you can get that'll actually alert you if you've got water running for too long, or if it has any suspected leaks. So you get a toilet running or whatnot, you can automatically get an alert for that since it's not theirs. But that was the first house I used private money on. Met somebody in one of the networking groups and said, hey, I've got this house. It's a great deal. Banks aren't going to really finance it the way that it is. It's got a lot of stuff wrong with it. I've got some money I can put down. What's your comfort level? How much do you have to lend? And I got somebody to lend, I think it's around $55,000, and then I covered the rest of it. And I was able to get it, fixed up, get it rented, and that one refinanced without any issues at all, to get me money back out again. So
that's great. So what was that conversation like with your first private lender?
It was the first time he had ever went as well.
Okay.
He's familiar with real estate. He's a real estate investor himself. So he was definitely familiar with the ideas behind why you would do it and what to look for. And the numbers on the property were great. So, he didn't have any issues with it. Took plenty of pictures, walked him through it. Got a hold of an attorney to draft everything up, kind of explain the process to us. Everything went really smooth with it, and talked to the attorney afterwards, and I said, so are the documents that you drew up for us, is that something that like I own, or do you have a copyright to them? Can I reuse them? And he basically said, yeah, you bought them, you can use them. I've been able to use that as a template for most of my other loans. And I'm actually a big advocate of Legal Shield. It used to be Prepaid Legal. So I'll kind of modify that, and then I'll send it over to them for review, just to make sure that I don't have anything crazy, and that's included in a monthly membership for a really small fee.
So Legal Shield is a monthly subscription, and they give you legal advice, or what exactly is that?
Yeah, so full disclosure, I use it a lot, and I found out that I can make money off of it. So my wife is actually a sales rep now. So full disclosure, if you want a link, hit us up. Basically, it's a subscription-based service for an individual. It's $25 a month, and you can call a licensed attorney in your state and ask as many questions as you want for that $25 a month subscription. For an extra $15 a month, you can actually add your business on as well, and they'll answer questions that are more business related for it, and they'll do document reviews with the individual package. I think it's 3 pages or something like that, but they'll do at a given time. With the business writer, they'll review up to 15 pages in any given time. So you want to have an addendum to your lease, or change your lease, or do up a land contract or whatever, you can actually take a stab at it yourself, send it over to an attorney, and they're going to tell you what's wrong with it for $25 to $40 a month.
Sure.
So really, really great service. Yeah. And then if you have anything proactive that you want to do, like, hey, I need to kick this person out of my house, I'm filing eviction, whatever, they're not going to proactively do things as part of that membership, but they'll refer you to an attorney that will service your area, and you'll get 25% off of that attorney's rates for anything that you need to do. So like when I had the legal paperwork drawn up, that's something proactive. Like they'll review paperwork, but they're not going to draw it up for me. So they referred me out to an attorney, and I got 25% off of the local rates of that attorney to get the paperwork drawn up. So highly recommended.
So yeah, it sounds like a great service. So was the process difficult? You were totally new to it, and your lender was totally new to it. Was it very difficult to do?
It really wasn't. There's only a couple of things that I guess 3 things that you really need. You need a promissory note that basically describes what your terms are. And then you're going to have a statutory mortgage. There's a specific Ohio revised code. If you're in Ohio, I'm sure it varies state to state, but there's a specific, basically a short form mortgage that's realistically, it can be as short as a page that gets filed. And then you're going to have an amortization schedule that gets referenced that you basically spell out, hey, here's how the money's going to get paid, whether it's interest only or whatnot. You're seeing the terms that are specified in your promissory note are laid out in that AM schedule. So if it's interest only for the first 6 months, and then it's amortized over 12 months or whatever, you just lay it out in that. Put it all together, get some signatures, and the title company at closing takes care of filing everything.
Yeah, that's great. So yeah, it's kind of a mysterious thing, when people hear about private money and finding these mysterious private lenders. But once you go through it, it's not a real difficult process. And the private lenders are the people that you're around every day anyway.
Yeah, and the important thing to think about with private lending, and I mean, it depends on the lender and what the lender's goals are. But for the most part, private lending does tend to be a shorter term thing. You've got a specific goal in mind. I want to acquire this property, increase its valuation. I'm going to need a second while this goes. This is why those high-rise offices are so expensive, right? They don't have to deal with ground noise. Yeah, so private lending, you just want to know what the lender's goals are. Typically, it's going to be a higher interest rate, and somebody might say, gosh, why would you pay a 8, 9, 10, maybe even 11 or 12% interest rate? And the answer is because the deal supports it. If you can get the right amounts of equity, the right amounts of cash flow, and you can refinance, but you can't buy it with traditional lending because a hoarder's living in there, or it's in really bad repair, or whatever's going on. There's all kinds of scenarios where you're just not going to be able to buy it with traditional lender. But it's a good deal. So using that private capital or that short-term capital or that HELOC or that credit card, as long as you understand the risks and you know, consider it a short-term thing that you pay back, you're going to keep yourself out of trouble. And there's definitely a place for it, and it allows you to close quickly, make basically cash offers on properties. So a lot of great things that you can do once you start to build up that private lender network.
Yeah, it gives you a lot of freedom, that's for sure. And access to deals that you would never have access to otherwise. So,
Yep.
So when you refinance a property, is this an ongoing relationship with your lender? Do they lend to you still, or do they lend to you again?
So that lender, unfortunately did not. He was going to, and he had another deal by the guy who introduced me to him came up, and it was just really poor timing.
Competitive times out there. Watch out.
Yeah. So, he did voice that he would be happy to lend to me again. He was happy with the process, and yeah, very receptive and amenable to doing it again if our timelines line up. And that's something you got to be, any investor that you work with, especially on the private money side of things, they don't want to have 50, 60, 100,000, $150,000 sitting in cash not working. So, part of your strategy really should be, okay, I'm going to try to line up this refinance with, I've got another deal for you, and I'm going to present them at the same time so that you can keep recycling their money, letting them, continue to put it to work, or have that choice as to whether or not they want to continue to invest to limit their own risk factor.
Yeah, that's great. So is there a point in this where you felt like it just took off?
That 6 unit was the thing that, okay, cool. I'm going really fast. I've got to get my feet kind of stable. Like there's been so many things going on. And actually, as I was searching for private lending for that 6 units, I had it under contract, no idea how I was going to close it, but I knew that it was a deal. So I was searching for my first private lender, and I drove by the building downtown, the one I'm actually sitting in right now, drove by it, and I saw that the phone number on the sign had changed out front, that had offices available for rent or whatever it said. And I was like, I wonder if Rob still owns that building, the guy who owned it when I was there with my computer business. And so I called his cell phone number, and he picked up the phone and said, Rob, I've been getting into real estate here, and I was going to see him before I could even get any further. He's like, oh, really? You want to buy my building? Well, not why I called, but let's talk, So he had moved out of town. He'd been through, I guess, a couple of property managers, and occupancy had just fallen since he had moved out of town. And he still came back like a couple of days a week, but he moved out of state, actually. It wasn't even out of town. So occupancy had fallen pretty far in the building, and the numbers on it weren't great. So we worked out a deal where we were able to, he let me have an office in the building to be able to work from. And then I was able to, as part of our contract, work to help get our occupancy up in the building. And if I could get the numbers to where they needed to be able to get an appraisal, and get the funding and whatnot, basically it would, if the appraisal came in where it needed to be, he was willing to do a seller second for a certain amount of money. So I got it under contract, and with what he was able to do, it basically gave me the equity that I needed for the bank if the valuation of the property came back right. So I worked, and we went from right around 50% occupancy up to a little over 80% occupancy. Everything came back, and with him doing a seller second, I was actually able to walk into the building with no money out of pocket. And technically it's a 25 unit building. Some of it's like adjoining doors, and this suite's rented with that suite type of thing. So anywhere from 18 to 25 tenants typically in the building, depending on how it's broken up at any given time. But that deal, it took a lot of work to get there, and it was a lot of sweat equity that, it could have just benefited him, and I didn't get the deal closed, but I was all right with that too. I had an office to work out of for the time being, and it worked out really well for both parties. So it was kind of finding that win-win situation. He had to walk away from the deal. It just, or not from the deal, but from the building. It was just something that didn't work for him anymore. And it's a great location, and it's really helped springboard a lot of what I've got today. Um, so that closed in January of this year. Actually, this January was absolutely amazing. I had a 4-unit building that I'd gotten under contract and was able to find a private lender to fund the purchase and the rehab. So I worked with him to get that 4-unit closed, met him up at a networking group. Actually, it wasn't even soliciting private lending or anything else. I was just up at this real estate networking group, and his brother looked really familiar to me. So I asked him, I thought I recognized him from a place that I'd consulted at, and I asked him if that's where it was, and he's like, no, but we got to talking, and they had funds and were looking to lend. So both brothers at this point have lent to me. And
Wow.
So they helped close that 4-unit, and then I had storage unit complex. Basically, it was empty. It wasn't generating any revenue. The guy who owned it had gotten it via land contract, and he had used it. He had a bunch of landscape crews and used about half of the facility for his own equipment for all of his various crews and whatnot. And he was kind of downsizing, moving stuff out to his house. And there's this facility, 47 doors, that just wasn't generating any revenue. He'd had it for years, and used about half of it himself. About a quarter of it was used by family and friends that didn't pay anything, and the other quarter had their rent's never been raised since the late 90s, and paying next to nothing. I've got one person like right around $38 for a 10 by 20 foot storage unit, which is I could double it and still be well below market. So looking at the numbers, it was a terrible deal. But I was actually able to get it with no money down for an assumption of land contract. Talked to the guy who held the contract, said, hey, would you sign off on this? Presented him with kind of my numbers the same way I'd present things to a bank. He agreed that I was financially stable enough to take it on, and was able to basically help this guy walk away from a problem. It wasn't generating any revenue. It was just going to keep costing him money after he downsized. So it was a win for him. I was able to get into it. We're putting probably about $50,000 or so into it. New roofs, getting everything painted. We're going to have to replace a handful of doors, key in, key out gate system, surveillance cameras, gravel, whole nine. But once we've got that done, if we can hit the national average of occupancy for storage units, which is about 93%, that should cash flow around $2,000 a month and be worth just shy of $400,000 when it's all said and done. And there's actually room for 2 more buildings to be built on the land, which could raise its value up to close to $750,000 by the time it's all said and done. So
that's awesome.
Yeah, so rockstar property. And then I had a single family that I closed with private money in January too. So I had 77 doors in January of this year to kind of catapult me.
Yeah, that's for sure. That's a good month. Holy mackerel. So anybody struggling today to get their first deal, just keep in their head that 1 month from now you could have 77 doors, right? It's possible.
Yeah.
You could have a rock star month.
And don't forget the sweat equity. Like the guy for the storage unit, when the person originally announced that, it was in a networking group, and there were 20, maybe 30 people in the room, and I took down the guy's information, like, okay, where's it at? And I drove by. He's like, yeah, the number's on a sign out there. And I drove out there, and there was no sign. I was like, I'm pretty sure this is it. Like, I mean, there's storage units here, but there's no sign, no phone number. And got a hold of the guy, and I'll check. And it took me almost 3 months between following up constantly before I made first contact with the actual guy who had the property and the land contract. So January was really a culmination of like the 4 or 5 months of work on the big office building all coming at once. The storage units, multiple months trying to trace that down. Had a longer contract period and whatnot for the 4-unit and finding funding for that. It really was an amazing month. But don't be afraid to hunt down the deals. There's so many times where just the follow through is really what gets you there.
That's awesome. Because I think, most people, if they were looking at it from the outside, they would think, oh, he found 4 amazing deals in January, right? And they don't really picture the months and months of effort that it took, and it just all came together. Kind of like that, overnight success. It just took years of effort to get that overnight success,
Right.
So I think that's a great point for people. It's not a get rich quick. You can't do it overnight. It takes effort and a lot of sweat. Yeah, as you said, sweat equity, right?
Yeah, and being able to have full-time maintenance people on payroll that are working on fixing up these other properties has been a godsend. As I've grown this rapidly. Like I'm starting to evaluate the processes. Does it make sense to have full-time maintenance guys and full-time per construction guys? Does it make sense to separate that out because we're getting to the point where we're busy enough to between spring checklists and fall checklists, and we make sure all of our places are well cared for. Um, it's getting to be a significant amount of time away from the burr strategy. My guys are complaining a little bit that I won't let them work. It's constantly pulled off again.
They like the burrs a lot better than the maintenance, huh?
Yeah, they do. So, but I couldn't do what I do without a great support network, and actually as I've started to grow, trying to take on the number of leases and everything else that January had that came with it, to figure out the storage units and everything else. My acquisitions that I've gotten after that, I've actually got a company that's helping manage pretty much all of those. Um, so it's starting to take some of the phone calls and some of the workload off there, so that I can continue to focus on finding the deals, finding the lenders. Uh, that acquisition piece is where the equity grows a lot faster. And obviously, the more you pay people to do things, the less cash flow you have, but it also frees up your time. So it's a really important distinction to make if you're trying to grow rapidly. Step back, look at the work that actually needs done. If you're doing these burst strategies, even if you're not doing the work yourself, are you still playing project manager? Are you still filing for permits? What things are you doing or not doing, and how does that play into your time versus what you could pay somebody else to do?
Yeah, that's awesome. I think that's a good point. My process was similar because when I started, I didn't have a job, didn't have any other income. I was just doing the burst strategy and living off money from the refinance. And I hired people really from almost day one. First, they were working with me, and then it was, multiple people, and then it was independent people. And I didn't have enough money really to support myself in the rents, for cash flow. But it was more on faith that if I just churned through enough deals and kept getting the refinances, that was what would get me to success or get me to my goal. So I was similar in that I really felt blessed to have guys working full time to help with that progress. So one thing that's a couple of really interesting things from your story. Your deals, you didn't find them from direct mail or a wholesaler, or it sounds like it was different interactions or different contacts that you made. Is that
Yeah.
how you see it?
Yeah, it was. I often joke specifically in front of my buddy Tracy. He's in a handful of groups with me, but I say I take Tracy's sloppy seconds because Tracy knows everybody, but he doesn't like the heavier rehab. So he'll find deals and funnel the ones that he doesn't like to me. But I go back to him and show him how good the numbers were after. So it's
Okay,
a fun thing to tease him on.
sure. And it also is interesting from the outside looking in that you have basically assets of three different types. Normally I see investors who really like singles and doubles, let's say, or apartments or commercial space or storage units. So it's interesting that you've done all of those. Have you had struggles with trying to figure out how to succeed in the storage space business in comparison to commercial, in comparison to residential?
Yeah, so that's actually something I've been focused on very heavily here as of late, and trying to figure out what the best strategy is. I kind of see, between the single family, multi-family, office, and storage, I see them as self-insulating areas of the market segment. So if the economy's booming, I think my single families and my office buildings are probably going to do a little better. As the economy slows down, the storage units and the multifamily is going to do a little better. I mean, right now I'm very blessed in the fact that I don't have any doors that are available. Like the second something's available, it's rented. So, we're in a good market right now for all four things. But as I step back and kind of look at it, developing a marketing strategy for these storage units kind of is its own job, like to deal with just the storage units. Same thing with the office space. I'm not running just office space. I'm taking one of the units and doing an office subscription model where you can pay $100 a month and get 40 hours worth of time that you can schedule on the website for a dedicated private office. So you can go to easyofficespace.com and you can sign up, and I plan to market it to attorneys that want a place that can just have an address in the county so that they can do court-appointed work, or maybe the small business owner that can't afford a real office full-time, but they need a professional place to meet with clients. Or as COVID's taught us, we've got a whole bunch of industries that just realized that they can work from home. The next thing they're going to realize is they need some heads down time, not with a 3-year-old crawling on their head while they're trying to work. So I think being able to offer space that meets that need is going to be a really powerful thing too. Gosh, that's another business, So I'm kind of starting to step back, and real estate is a means to an end goal for me. And as I start to look at what I really have, is I've got a property management business, I've got a construction company, I've got the storage units, I've got the office space, the way that it works out. So I'm trying to really abstract myself, see what I can start to delegate out, and start to work at a higher level on the multitude of businesses that I have, and let other people do some of the work down in other areas, and figure out how can I grow each of these businesses. I started talking with different business coaches and things like that to help me focus on what's important now, how do I keep the right focus when I'm dealing with as many aspects of what I'm working through. So it's definitely a work in progress right now. I've grown this quick, but it's something that I've recognized is going to need a lot of work to make sure that I can stay on top of it, get the right things hired out, and work on the business and not get weighted down with all the phone calls, all of the day-to-day stuff that is going to slow me down.
That's great. That's great. So moving forward, do you think there's one area that you prefer, or what are your goals moving forward?
My longer-term goal, so my short-term goal is to get to the point where I can leave the day job, and then I want to continue growing at a fairly rapid rate until I can get to the point where I've got about 4 to 5 times what I need for myself. And once I get to that point, like I said, I've always had an entrepreneurial type of mindset. I've actually got a big list of ideas that I would love to build. And I've met a lot of brilliant people throughout the different areas that I've worked. I would love to have the passive income to start up a R&D type of company that says, hey, can I make X, Y, or Z? And if it takes off, have that as an exit strategy, build up that company and sell it off. Let's try the next idea, build it up, sell it off. And if it doesn't take off, who cares? It was built with passive income. So that's kind of my longer term goal, is to get to that point. As you look at, especially commercial real estate, what makes more than real estate? Well, the businesses that are in there either have to make money or they're not going to be able to pay their rent. So how do you build a business that's going to be successful on top of other businesses that you already have that can help feed into that? So that's kind of where my mind's going from a longer term perspective.
Okay, that's great. So for the person who's just getting started and they feel overwhelmed by everything, the finding deals, the numbers, the managing, all these things, what advice would you give them for getting started or taking that first step?
Hands down, just do it.
All right.
You will find out that there's a saying that if it wasn't for the last minute, I'd get nothing done at all. There's a lot of truth to that. You're going to do what you have to do. And if you buy it and you've got your own money, your own assets on the line, you're going to figure out a way to make it work. So the more education that you can have coming into it, the better. Plan to, a lot of real estate investors, myself would have been in this exact same boat had I not met the right people along the way. I didn't know to plan for a management fee. If you buy a house and it only makes money if you're managing it yourself, you just earned yourself a job. So,
Yeah.
is that what you want? It's fine if it is, but if there's no money left over after management, do you really want that dealer? Yeah, it might make sense, and maybe you're fine saying, "Oh, I'll let somebody else manage this, and I'll make my money off of the other things." But you're never going to know until you get into it. Just get into it, see what's going on. You're going to learn a lot faster that way, and hope that a pandemic or something crazy doesn't hit in the middle of it. I guess. I don't know.
That's right. I'm fairly certain that the next few months won't be as crazy as the last few. So now's a good time to start, right? Just do it. I like it. So, what I guess as a closing note, what is your big why, or what big rewards have you seen in your couple years with real estate as an encouragement? Because I know when people do get started, they're going to run into headaches and obstacles, and they're going to wonder, is it all worth it? So from your perspective, what rewards have you seen, or why is all the effort worth it?
So I have, in 2 years' time, I have replaced over half of my take-home income with passive cash flow. Right now, I'm putting that 100% back into the business. So don't pretend for a second like I'm rolling in it, because I'm not. I'm very, what they call, house poor. But I've been able to grow a lot of assets, and frankly, the more assets you have, the faster they're going to multiply. One of the numbers I really enjoy looking at is the amount of principal pay down I get each year. Um, I've got over $50,000 a year going towards basically a retirement account, right? You're just getting equity paid down, and it's money that you can borrow against if you had to. But it's a really fun number to watch that go up, and it far outpaces anything I was able to put towards retirement otherwise. And that's just one piece of the puzzle. So know your numbers, see how things pay down, know your goals. If you know your goals, if you want to continue working a day job, like I said, there's nothing wrong with having a property that's cash flow neutral, because you're still going to get tax benefits, you're still going to get appreciation, you're still going to get that principal pay down. But know your goals, because if you don't step back, know what you're trying to achieve, you're never going to know if you get there. So
That's great. Well, CJ, how, if people want to find out more about you or get in contact with you, what's the best way for them to do that?
So my company name that does the property management is UPIC2Rent. It's the letter U and the number 2. So you can send an email to info@upic2rent.com. Our phone number, if you want to call, is 740-205-8624. And that does have that annoying little PBX that sends you directly to my voicemail after hours. So leave me a message if you want to call late. And I'm in the office pretty much all the time, so I'll probably just get the email attachment and you can call back. But that's probably the best way to get a hold of me, is either through email or phone, or hit up the website. You can see what we've got going on, some of the listings, things like that as they come available.
Okay, great. Well, I really appreciate you taking the time, coming on, and getting to share your insights with everybody and your story. I know people are going to be inspired by it, and lots of great information to help them in their journey. So thank you again, CJ. Appreciate it.
Yeah, thanks for having me. And one last little plug: if you do call that phone number, there is an option to press for prepaid legal. My wife would love it if you have, or for Legal Shield. I do highly recommend that service. I use it probably 2 to 3 times a month. So super awesome for getting questions answered, lease amendments, reviewed, all kinds of stuff. They'll even send collection letters and stuff like that for you. So one last little plug there.
All
There's
right.
not annoying PBX.
Sounds good.
Thanks for having
me. She'll be really excited for that.
Yeah.
Right? All right. Well, thanks again, and we'll talk to you soon. All right.
Have a good one.